Hi, class. I'm here to talk about my snapshot for Colombia. Um, Here's a detailed review of Colombia's snapshot from 2024 to 2025. And I chose Colombia. The main reason is that's where my parents are from. And I've been there many times throughout my life. So of course I love the country. Also, it's the third largest economy in Latin America by GDP standards. And it's known for its coffee, flowers, and other growing services that they have that we'll talk about. And right now, just looking up information, they're showing a remarkable post pandemic resilience with above target inflation while ensuring continued sustainable economic growth and reducing informal employment. The four factors that I looked at here in our infographic was GDP growth. And as you can see in quarter three, 2024, they were at 2% increase growth rate. And in quarter three, 2025, they were 3.6%, which is an 80% change. And in 2024, they were low. And as you can see in 2025, they're recovering. And this is driven by just strong domestic consumption and investment in civil works. And it continues to show that recovery is underway. And as you can see in the second bar, the unemployment rate is also showing positively. So in quarter three of 2024, it was at 9.8. And then it reduced in quarter three, 2025 to 8.8, which is a 10.8% change. And this shows that the labor market is strengthening significantly. Job creation still leans heavily toward any non-salaried informal sector, which may pose long-term challenges for productivity. The third factor that I looked at was inflation rate here, and inflation in quarter three, 2024 was at 9%, and now it's above target at 5%. So really just minimal change. It's stable here. It still shows that it's persistent, and they are the reason that it's persistent, not changing as much, or stabilization, I mean, is due to services are being regulated. In some of the articles that I saw, they are regulating gas, transportation, like they have Uber as well. So they're starting to put regulations in place to mitigate with the inflation. And the last one that I picked was the trade current account and deficit. And what this shows is that the goods trade deficit is at 23.8%, which is not good. It's leaning more towards imports. It means that it's widening and it's projected to increase. And this deficit is expanding as resilient domestic demands pull in imports faster than exports. And that's why you see the scale is leaning towards the imports. And this suggests strong internal purchasing power, but raises concern about the external balance. So as you can see, late in 2024, the information or data from the central bank, or it's also known as DANE, is showing that Colombia is trying hard to aggressively. The central bank had aggressively raised interest rates to combat the high inflation due to post-pandemic, and you were seeing higher prices, tight borrowing costs, and slow growth. And in the current condition, in late 2025, the economy is now in a moderate recovery phase. The GDP growth is healthy, unemployment is low, but it's still recovering, and there's still inflation is still rising, even though it's still slow. In my opinion, looking at the upcoming quarter and some of the articles for Q1 of 2026, the real GDP growth will moderate slightly but remain positive, which is good. They're still looking at preventing continuing to dampen sensitive sectors like construction and long-term investment. And this will just continue to keep this healthy or and positive. The unemployment rate will continue its gradual decline towards that 8% rate, looking towards 8.5%. The Colombia is looking to create more jobs, but the formal job creation will be slow. The annual inflation rate will remain what they call in those terms, in economic terms, sticky, and you'll see a short-term upward pressure. The convergence of the 3% target will be slower than previously hoped, and then probably stabilizing in the 4 to 5% range. Excuse me. And lastly, the trade deficit will continue to widen. Strong domestic demand and a stable exchange rate makes imports attractive, sustaining the deficit. So that's good news, but it will continue to widen. And this information that I received overall was from, like I mentioned, the Dane and the Banco de la República, which is the Central Bank of Colombia. Oh my gosh, I'm Spanish and I can't even say it, but the Central Bank of Colombia. And it's holding its benchmark interest rate at 9.25%, and this was in October of 2025. And it's acknowledging the strong domestic demand and resilient economic activities which supports GDP and low unemployment. And this confirms that they want to keep inflation in control. And the last question, if I were part of the Economic Advising Council, which one would I pick, neoclassical or Keynesian policy? I would probably lean towards a neoclassical government approach due to addressing the core problem, which is inflation. They're experiencing a strong growth, GDP, unemployment's down, but there's still a critical problem with the inflation piece. As I mentioned, sticky. And this is not a lack of aggregate demand, but rather capacity constraints and structural rigidities that keep prices high, like indexation, regulated services. Also, the neoclassical approach supports the central bank's restrictive stance in the interest rate of 9.25. And this controls the money supply and maintaining fiscal discipline to manage inflation expectations and bring prices back to the long run equilibrium. And there is also a long run supplies focus. If we were to go to a Keynesian policy, this would simply boost the aggregate demand and shift the curve to the right, which will only exacerbate the current inflation problem. And therefore, the neoclassic approach of favoring supply side growth and fiscal responsibility is necessary for Colombia's long-term economic stability. Thank you for your time. Have a good evening.